what is Canadian housing going to do? And it's a problem that you can't solve. Literally, it's a supply problem, right? And supply takes 3 to 5 years. The rub here is we can't build it fast enough. And with the higher interest rates, we literally can't really build it.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
All right, the Bank of Canada did what everybody pretty much expected they were going to do. They kept rates as they are. But we're going to hook you with this because there were some things that you need to know from TIF's announcement, more specifically, like what's been going on for the better part of the last few weeks and months in a really interesting market, to say the least. So we're going to talk about that. But I got a co-host today on the show.
That's right.
All right. Mr. Matt Scalena.
That's right, Matt Scalena, co-host of the Vancouver Real Estate Podcast, realtor here in Vancouver.
There we go.
Very excited to be here, Alex.
You're going to introduce it. I did. There we go, man. This guy's done this before a few times.
I'm right at home.
Awesome.
I'm literally in my own studio, so I'm right at home.
We're doing a little guest studio recording on this one here today. Bluntly, like Matt, you get a chance to talk to a lot of people daily as it comes down to the Bank of Canada's decisions and what's happening in the marketplace. So I'm excited to walk through this list of topics with you and get you to add in some color. I'll just jump into it right away. Bank of Canada kept rates where they were, 5% overnight rate for the 5th consecutive cycle. Were you surprised by that?
I wasn't surprised by it. You know what? I think everyone kind of fully expected it since about late last year, at least. We've been hearing that it's a June or July kind of transition to lower rates. One thing that I'm not surprised by, but we were talking about it offline a little bit, that struck me about yesterday's announcement is the data just keeps surprising to the upside in terms of not doing what everyone was thinking it's going to do, which in my mind means potentially fewer rate cuts this year and potentially a slower move or transition to cutting rates, which is not great in my mind. But that was my big takeaway.
The data is persistent. It's very persistent. I mean, and you have to dig pretty deep into the data to kind of get a better understanding as to what's actually been going on and where things are going well or where they're not going well. So what was somewhat, I don't know if it's unique, but was a little bit different about this one is TIF came out in the morning and had actually a conference right away and spoke about what his thoughts were of what's going on. And he was pretty candid to be upfront about where things were at and where things are going. I think that virtually everybody at this point right now knew that March was going to stay the same. What's interesting is that, I felt almost like a little bit of a lull for the last 2 weeks. I think you did the same, right?
Yeah. It's interesting. This, I would say, what we're at the start of March, this market of 2024, January started like gangbusters. Like it was like, whoa, what? It was almost like New Year's resolutions or something. Like suddenly the phone's ringing off the hook. And in the last couple of weeks, it's really slowed down, and it's trying to get a feel for what that pause is, like what it's all about.
Yeah, and then this is interesting because, I mean, we typically find that the week before the announcement, there's usually a little bit of a lull. At least I found that on the mortgage side of things as people wait to
interesting.
See what can the Bank of, what are they going to do? And then there's usually a week or 2 weeks afterwards where there's like some positive, they didn't change things. Okay, cool. Well, let's go buy a house now. We're good to go, right? That sort of thing. And so again, I think I felt that. And then literally an hour, you and I were talking briefly yesterday, an hour after that, I got like 3 calls. So, it's this like holding pattern, but it's almost like, I don't know if people are expecting rates to go up or they're like, hey, if they don't go down, then I don't know. Anyway, so
it is funny, honest to God, that our maybe it's just our businesses are in sync for some strange reason. But now that I think about it, last night my wife bailed on the Canucks on Saturday, so I've started reaching out to people like, hey, you want to come with me to the Canucks game?
Yeah.
And it was like 2 or 3 people were like, can't make it. Got a friend. It was like referral. And I don't think it was due to the Canucks. I think it was like suddenly I'm like, oh man, what this is like, we're back in action. That was literally what I was thinking. So.
Yeah, that's interesting. So, I mean, let's dig a little bit into what TIF said and what his feedback was. I mean, a couple of things that I picked out of that was that he was pretty clear and indicated that there hadn't, he said in his words, there weren't any significant surprises prior to this announcement from an economic data perspective. He's basically saying like, this is pretty well what we expected. A little bit of up and down is not shocking or surprising as it pertains to data. As someone asked the question, I know you've got a good point that we're going to talk in a second here, but someone asked the question around the impact of rent and mortgage costs on inflation, because we all know there's a significant amount of the data right now that's showing that rent and mortgage is a significant percentage of what people are spending their money on right now. And that's gone up so much. And he's like, no, our preferred measure, CPI trim, we strip out the upper half and lower half, which would mean mortgage and interest, right or wrong, and we look at the underlying data. And in his words, the underlying data shows that we're still persistent this time. So they're not ready to lower rates for that reason. Now, to your next potential point there, which I'm hoping that you jump into, we are following the guys south of the border, right?
That's what I was thinking. Like, one of the things that we're always thinking about is the Bank of Canada in relation to the Fed. The difference in my mind is it's a tightrope act, right? Because the U.S. is performing. I think the economy, as I understand it, is doing a lot better. So there's a lot of downside for the U.S. to lower rates and not a lot of upside because the economy's firing on all cylinders. Where the difference is in Canada, of course, is that the economy is not doing as well, but there's a currency considerations. There's a lot that goes into walking your own line in relation to the Bank of Canada when it comes to the Fed.
Absolutely. And I think the one thing that we've known for a long time at this point right now is they kind of want to follow what happens in the U.S. They don't want to lower rates before the U.S. does. Obviously, the impact on the dollar, as you just mentioned there, is a significant consideration.
Right. So, yeah, I wouldn't want to be in Tiff's shoes.
He didn't look very calm and collected, although he dealt with it pretty easily. You could just see the sweat dripping off the brow like, at this point right now. Some things to consider here as far as inflation, some stats, because people like numbers and stats and so forth. So Canada's core inflation right now, which is what they're focused on, is averaging about 3.35%, which is the lowest of 36 months. But their target is the 2% range. We saw the numbers come in a bit lower in January. It's just because it came in low 1 month doesn't mean we're there yet, right? So they do want to see things hit the 2% range. But if we see things continue the way that they have so far, there's a very good chance that we do hit that in the next 3 months. But Tiff insinuated, right? He insinuated and explained actually just straight up that they need to hit that number or want to hit that number before they do anything. And they understand the potential impact on the housing market. The moment that the rates could drop is just wildfire. So they're like, nope, we're going to hold on and it's going to go slow.
I wonder how much of the consideration is around our housing problem, let's put it that way, in terms of, an ongoing housing crisis, clear pent-up demand, and a lot of people on the sidelines just waiting for the Bank of Canada to do anything. And of course, price appreciation is inflation. It's not a good look. It's not what they're wanting. But I wonder how much if it's an outsized portion of their considerations at this point, what is Canadian housing going to do? And it's a problem that you can't solve unless, literally, it's a supply problem, right? And supply takes 3 to 5 years. And the rub here is, we can't build it fast enough, and with the higher interest rates, we literally can't really build it. So it's like a catch-22. Yeah, I mean, it's an interesting. I'd like to be on a fly on the wall in the meetings because it's a really interesting problem.
There's no doubt, and to that point, I mean, you've got the Bank of Canada trying to do one thing, and then he sees that there's a federal budget coming up here in I think April, May. I can't recall the time here, but pretty quick. And someone actually asked this in the meeting, and they said, how much does what you do have an impact on, or vice versa? How much is what they're going to say have an impact on the April meeting? Because you're going to have your April meeting, and then they may not have had their budget yet. And for those listeners who may not know, obviously, if the government spends a whole whack load of cash, then that's going to cause some challenges as it pertains to trying to get that inflation under control, right? Like, because they seem to print money like it's going out of style over there. Whole other conversation for another day. Yeah. So I think one of the key takeaways that I had there was just the reminder by Tiff that we're not going down an elevator. We went up an elevator, we went up quick, and we're going to go down much slower. And he reminded everyone about that yesterday. Like, we're going to go down much slower than we went up, which has kind of changed some of the forecasts as far as when interest rates go down. So instead of that potential April, which is possible but unlikely, it's more likely that we do see that June, July timeline here that we've heard about as the earliest. And he didn't really say that was the case, but that's, you read between the lines, a likelihood, if you will. And then the second thing is, where everybody was suggesting at the start of the year, or at least a lot of economists, the average was about 1%. Like, we're going on 1%.
Yeah.
A few are still suggesting that, but most are now saying, hey, it's 50 to 75 points this year, and it's going to happen over a longer period of time than we initially hoped.
What do you think that does to the market?
I think it bottles it up more. I mean, it might not be a bad thing, but you just mentioned it right off the bat. The supply issue is massive. It's not going anywhere. I think you've got people sitting on properties that aren't developing and probably won't until it makes sense to do so. We've seen developers sell off land because they couldn't hold it any longer because of the high rates, which is obviously negative for supply as a whole. And so, I mean, if you're in this position right now and you see that the property values aren't significantly declining, or you don't think to project out, look at it and think that it's going to be worth your while, then why would you develop right now? Why not wait a little bit longer? Unless they have to at this point, which if they have to, they're probably not going to because they don't have the money to do it. So I think that what they're doing here is they're just shaking up the Coke can a little bit more. It's like it's shaking up, it's bottling up, and then when we do see that rate cut happen, I think the market will jump in pretty quickly and move forward. But in the short term, there could be a little bit of consumer, maybe not concern, but there could be a little bit of trepidation for people thinking, oh, maybe we do wait a little bit longer.
Yeah. I feel like this is what we've been talking about for the last 2 years, just that slingshot being pulled back further and further.
Good analogy.
Right? Just in terms of demographics, people, in life cycles needing to buy, millennials, right? It's the largest demographic bulge since the baby boomers in that segment of their life. When they're buying real estate, they're moving through the market, the immigration that's coming to the country that everybody's talked about. I mean, there's all sorts of forces on demand, and it's still seeming pretty, considering that it's seeming like there's, sales volume I think is up this year over last, but it's still really low. It's still really low. And you can just feel it pulling back. And I mean, if you're in Vancouver, at least, or BC for that matter, demand shocks. We've seen multiple demand shocks over the last decade. And everybody knows what that feels like, where the market's doing 3-5% month over month, multiple offers on everything. And they seem to just come in waves. And it's hard not to imagine at some point in the next year or two that we're in that exact situation again. And, no matter what the policy is, we can't get it right because we're not able to build our way out of it. So.
not at this point, right? You're absolutely right. And I would argue that there's implications of holding rates as they are that no one's thinking of. And we've seen reports about the baby boomers. We're just going to stay in our home right now. It doesn't, for the cost of borrowing or our situation, we're just going to hang out here for a little bit longer and stay there. You've got people who are almost like in prison in their home, so to speak, which is an interesting side note conversation that we could get into. But I think the effects of higher rates are just really starting to take hold now. Like, we're starting to see the impact on the marketplace. We're starting to see a point where, hey, people have now used their savings or are pretty close to it, and now they're kind of paycheck by paycheck or using additional debts. And I think that's why we're thinking that, at least that's why they might be suggesting a 3-month timeline, because as we move into the summer, people traditionally spend a lot of money. They go on vacations and so forth. Well, maybe we don't see that as much this year. Maybe people are saying, maybe I don't go on that extra vacation. Maybe I don't spend that extra money. And
I anecdotally have talked to a lot of people in the last couple of weeks that are in pretty crappy situations. I feel like I've heard of multiple people, friends and friends of friends, being laid off. Like, it doesn't, if we're not in a recession, it doesn't feel like we're not in a recession in a lot of ways, right? Like, I feel like almost across the board, you can feel people pulling back in across all aspects of life. The
higher rates are having their intended effect. As painful it is and ugly it is, because I hate to, from an empathetic perspective, I hate to see it. I hate to hear about it. We hear it firsthand. But to your point, I mean, that's just it. But that's another reminder of like this impact of this low supply, because for as many people who are dealing with pain, there are way more people out there who want to get into the marketplace or want to buy a home, and they still have the financial capacity to do so. But that is the one thing that could actually change no matter what TIFF says at this point right now, is if the data comes out and we do jump into a little bit of a deeper quote unquote recession, which it doesn't mean that home prices are dropping by 20% or anything like that. In fact, probably to the contrary, house prices would be remaining the same or staying higher. But that would emphasize the importance of reducing interest rates sooner than later.
For those in the real estate industry, bad news is good news.
Yeah, I guess so. As a side note, because our end users are real estate agents, mortgage brokers, end users, clients, investors, like all these different types of people. I think like what this says to me is that whoever's getting this information right now and listening to, whether this be this podcast about the Bank of Canada or anything else from that matter, information education is key, but don't overanalyze everything, because the amount of data that's coming out, like we talked about this before, but we see like everybody and their dog is posting economic data and digging so deep into it that it's becoming interwoven in society to a point where people basically don't do anything, or they're scared to do anything because of the data, right? It's like,
it's such a weird moment that way, right? Like even the way we were talking about how's the market, it's like, well, 3 weeks ago was really busy, but then there's a 2-day lull. What does that mean? How does that relate to the Bank of Canada? It's like, it's such a strange moment for micro analysis maybe, and trying to sort out what's going on. But I guess maybe that comes with just a general sense of unease and uncertainty, which I would characterize the last 2 years, which of course is, I think, why sales volumes and inventory have been low, because you don't make big life moves in uncertain times. And I feel like we're very much in an uncertain moment. With more certainty coming, though. It feels like there's more and more certainty.
We're definitely in a more certain place than we were in 2023. No doubt about that.
100%.
People are moving, people are buying. We don't want it to sound like they're not. Like, obviously transactions, at least on our side, are anecdotally up. Seen people list a lot more properties where they wouldn't feel comfortable doing so before either.
Yeah, from a year ago, we're way up. That's for sure.
Yeah. So listeners, we still are doing real estate, but yeah, I agree with you from that approach. Okay, so let's just talk about the next couple of months. Moving forward, the next announcement isn't until April 10th. So that's, what is that, about a month, just over a month from now. This podcast will go out in a few days' time, and we've got 30 days. What is your prediction over the next 30 days? What do we see happen? Do we see anything change? What would you suggest based on the craziness of the last few months?
In terms of
market conditions, do you think we see more activity, less activity?
Oh, I think we see more activity. I think what we're seeing moving into March, like the spring market is the busiest time of year. Yeah. I think from what I'm seeing, a lot of people that have maybe been sitting on the sidelines for the last 2 years are just fed up.
Yep.
They want to get into the market. They want to make these life decisions that they've maybe put off. That's why I think we're seeing more inventory. That's why I think we're seeing more buyers. And this is the time of year where there's historically the most activity. I would say we're going to see a fairly, in the context of the last couple of years, a fairly busy spring here, and we're seeing it already.
Matt, have we passed the bottom?
Yes. Yeah, I would say so. I think that was maybe October, November of last year.
There we go. You've got it straight from the source, Vancouver Real Estate Podcast, the man himself, Matt Scalena. We have passed the bottom. But the thing about when you see the bottom, the cool thing is that at this point, we're so close to it at this point right now, you can still ride the wave up, right? This
is what I was going to say, is that, and we talked about it a little bit, again, off the mics, but this is a time where savvy people are engaged.
Yeah.
And it seems pretty clear, like the writing's on the wall. The people that are moving right now are more in tuned with, I would say, the general conditions of the real estate market and the general economic conditions, and that's why they're acting now.
If I had to look at it, if you think about concerts or festivals these days, they've got your like super duper early bird like VIP tickets. Those guys were the ones that did something in October through December, even if they didn't know it, right? And then you've got your like early bird VIPs, maybe January. Now you've got your like VIPs right now, so you're still rocking.
Yeah.
And I think we've got maybe one more layer until the general admission comes in, which could be sometime in the summer or the fall at this point right now. And I mean, the truth of the matter is, we've talked about this many times. In 5 years, whatever, if you buy this month or if you buy in December, you're not going to regret it from that standpoint. But I just look at it as almost like I'm seeing this like the slingshot. It's pulling back. It's pulling back. It's pulling back. That doesn't mean like jump out today in this first minute, buy your first property, like figure out what you got to do properly. But like, we're seeing just the compound effects exactly the same as we've seen in the past. And if you're looking at a graph right now, yeah, sure, we might not be in the very, very, very bottom of the dip, but you're there before that next level. So if you like the idea of it, then perhaps from an economical perspective, it might make sense for you.
Yeah, and I mean, what's the alternatives? Wait for the next dip?
Yeah,
Like,
yeah.
when's that?
Or you can follow the angry guy that's on everyone's YouTube channel that says we are going to hit the next dip and we have no idea what we're talking about, even though we do hundreds of transactions every single year. You pick and choose. I'm a mortgage broker just trying to sell everybody on everything. You're a realtor that's stealing people's money. Sorry, yeah, just a commission hungry jerk. I'm just kidding. Hey guys, this is a short, quick episode. Matt Scalena, Vancouver Real Estate Podcast. Thank you, Matt.
Hey, it was a pleasure.
Absolutely.
Impromptu podcast. I love it.
Yeah, and the man knows how to talk, so we've got that going on. Check out Matt's podcast, Vancouver Real Estate Podcast with Adam Scalena. These guys are rock stars. Got a lot of great content going out there that you'd absolutely love if you haven't checked it out yourself. So please do yourself a favor. And if you're loving the show, make sure to give us a rating and a review. See you next time. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.